Russ, what are you guys telling your clients at BlackRock today?
Well, look, I think beyond the humanitarian impact, the big question investors are wrestling with is how much will this impact Chinese growth? How much will it impact global growth? It's coming at a difficult time in the sense that the global economy is just getting off of its feet, just starting to recover from the manufacturing recession. And the extent to which this changes people's view of how quickly that recovery happens is what's being discounted today in markets. It's why cyclical assets are getting hit. It's why there's such a strong bid for defensive assets today.
Alejo, what's your assessment of how much of an impact this could have on China's growth and therefore global growth?
Of course. First off, my thoughts are with those in China. Challenging times there today and in these few weeks. It's important to take a step back, focus on fundamentals. We think the effect on Chinese and global growth is likely going to remain contained. Historical cases have shown that at most we see a temporary hit to growth of 1 quarter, and then we see a swift recovery based off on the cases of the SARs in 2003 and the MERS in 2015. So we think our base case scenario is at most we'll see a temporary hit to growth. So focus on fundamentals, remain invested, and don't make hastily choices.
How can you guys estimate that it's only a 1 quarter impact?
Based on historical cases, if things don't get worse from here, we think that the prospects of a deeper macroeconomic rout is limited.
Russ, what do you make of the way investors have reacted over the last week, particularly today, and in light of the fact that bonds have moved so significantly? Do you think this is a more pronounced and potentially long-lasting risk-off move, given that it's coming off the back of such a strong run for risk assets?
Not necessarily. I think actually the underpinnings of the market, of the global economy, still look solid. Let's not forget, one of the factors that really supported the rally has been very accommodative monetary policy, strong liquidity out of the Fed, the other central banks. That doesn't change. If anything, it perhaps grows. Now, I do think the key is the global growth impulse. Assuming that this is correct and that this is a temporary effect, then I do think you'll see people come back into the markets. But to me, the buying of treasuries, the flight to gold, the outperformance of defensive assets like utilities, which have just been ripping, this all reflects people trimming their global growth estimates and a little concerned about the uncertainty of how do you discount something that at the end of the day is a public health issue, not a financial issue.
Keith, I was in Davos last week, and all the world's top decision makers were pretty optimistic about global growth. Sure. We had the big trade uncertainty kind of behind us with the U.S.-China trade deal, the USMCA. Yes. Things are all looking good. And the question is this the type of shock that could disrupt that kind of narrative and the growth numbers?
Well, I think it could. I mean, the cases that it could, and let me caveat it at the end, as I always do, it could. The cases seem to ramp up pretty quickly. But again, as I mentioned earlier, Chinese officials are getting it contained. Wuhan is 9 hours by car from Beijing, is 12 hours from Shenzhen. So they're keeping people away from those major business centers. But I firmly believe that, like we've seen with other outbreaks, other potential pandemics, we will come to realize that this was just an opportunity for people to come to the sidelines for a while and then jump back in. So I'm agreeing with Russ and Alejo. The fundamentals haven't changed for me. I would be investing in here at certain levels.
Alejo, as an emerging market strategist, are there any emerging markets that particularly benefit as well from the lower oil prices that we've seen, which have been quite a pronounced move, or any other factors at play?
Of course, whenever oil prices move, you need to see the reason behind that move. And in this case, if oil prices go lower, that most likely is because global growth is expected to be lower, and that's rarely good for any emerging market. So the question here is how long will lower oil prices be here for? And again, we think that conditional on past experiences, if this is managed within certain limits, we think global growth will be able to continue moving higher in 2020.
So everyone here at the table, and Russ, you included, agrees that this could be a temporary hiccup. What about the fact that valuations, technicals, sentiment all got pretty stretched coming into this? I mean, maybe this is an excuse to sell off, but those factors, how are they going to impact the way the market trades going forward?
I think it's a great question, and it goes to something Michael Santoli spoke about a few moments ago. This may be temporary. It probably, hopefully, is not an existential threat to global growth. But you may also not see the snapback you saw in 2003. And one of the reasons, in 2003, you were coming off of a 50% decline. Today, you're coming off of a 35% rally. So I do think that will affect the extent to which you see a bounce even under a best case scenario.